So many investors are flying blind, chasing yields or buying covered call ETFs without a clear strategy behind it. They know diversification is important, but they're not sure how to diversify. But what if you could break it all down into just 3 ETF pillars and finally see your portfolio with simple clarity? In a recent video, I introduced the new concept of categorizing all covered calls into buckets, which I called the core base, the yield base, and the juicers. The response to the video, incredible. But more important, the feedback was even better. So today, using the valued input from all my viewers, I have refined it with stronger, more memorable pillar names, anchors, boosters, and juicers. And I'll show you how this framework can become your personal diversification compass. In this video, we'll walk you through the criteria, the strategy, and how to assign target weights to each pillar that actually align with your investment goals. And yes, I'll reveal exactly how my own PIIverse portfolio is structured across these 3 pillars. So, if you're serious about passive income, this is the framework you've been waiting for. Please stick around with me and let's walk it through together. Hello everybody, my name's Perry and welcome to the PIIverse. So before we get started, very important disclaimer and notice to all my viewers. I am not a licensed nor trained financial investment or tax expert. I'm just a retail investor with a passion for investing, sharing my personal knowledge and experience from my own investing journey, be it right or wrong. Viewers must not take any content, thoughts, or opinions in this video as financial advice. Do your own research and consider professional advice before investing. This content is for fun and entertainment only. All right, now that we've got that out of the way, again, my name's Perry and welcome to the PIIverse. This is going to be a real exciting, I think this is going to be one of those few videos that'll be top of my entire channel because I think it's a very critical, eye-opening component of a diversification strategy. It will really help a lot of my passive income investor viewers that are trying to build their own portfolio and their own strategy to meet their goals and are really struggling with regards to diversification. This one will help you, I believe. So let's go through the agenda. We're going to start with an introduction, and then I'm going to do a thing called the ETF Pillars of Income Investing, followed by the ETF Pillars for criteria table. Then the ETF Pillars table, important notes regarding the table, which all people should know about. Then we'll do what's called the ETF Pillars for Diversification Strategy. How do you blend this new concept of ETF Pillars into your diversification strategy? What I'm then going to do is actually provide you some examples of ETF pillar weights being used in multiple types of strategies. There is no one strategy. My PIIverse portfolio is just one income investing strategy of hundreds of different strategies. So this is going to be some examples to show you arbitrarily, hypothetically, what some other ones might look like. And I think it'll be very valuable so you can see these different kinds of examples. And then finally, I'm going to actually show you my own PIIverse ETF pillar weights being used for my portfolio to show you how the pillars look like in my own portfolio. And we'll talk about that. Finally, I'm going to then have some conclusions and I'll let you go on to your business. So let's get started. All right, the introduction. So, like I said before, recently, I released a video explaining 3 categories of income ETFs within a portfolio base that were based on yield and NAV distribution stability. The video looked like this. You could see right over there. That's the video. And I really would encourage anybody that has not seen it, maybe take a look at it again. Again, this is an update and it's going to actually be some improvements and adjustments and enhancements to this initial video. But I think the video itself will still be valuable for anyone who hasn't seen it. So please take a look at it. But anyways, it was initially these three categories that I was called, and you can see it in the triangle. The three categories that I had identified were called the core base, the yield base, and the yield juicers. And I presented this criteria that could slot an income ETF into any one of these categories. So if whatever the covered call ETF was, the way the concept is that basically if you had the right criteria, you could take an ETF, any ETF, covered call ETF, and say, where does it fit into? Is it a core base? Is it a yield base? Is it a yield juicer? And then that would help maybe clarify what your portfolio looks like at a much higher, broader level, like the 100,000 foot level. But the video was very valuable to viewers. I got so much great responses, but what's even more important is that I received a lot of great feedback on the initial concept that let me think, maybe there's a way of improving it, because some people brought up some really good ideas. Some people challenged me on some of the criteria, which I actually, after having some soul thinking about it, I thought, hey, you know what? That is true. Maybe we have to restructure this. So this video is an improvement on that. So using this feedback, I made major changes and created this updated, enhanced video to provide a valuable strategy resource tool for all you passive income investors that can now incorporate this into your strategies. I show an update of my own portfolio diversification with the updated 3 pillars of income ETFs. So in the previous video, I actually took my diversification of my PIIverse and I showed you what it looked like. I've now use this new concept, which caused some changes in the in the structure layout of my portfolio, and I'm going to now reflect those to you. I provided examples on how setting target weights for each pillar and simple strategic guidance can help maintain a portfolio's diversification mix and deliver on the investor's goal. So this is what I want to get through today. So let's get started. All right, so first we're going to talk about the ETF pillars of income investing. So here is the new layout. I've created 3 new simple labels for each pillar, easier to remember and use in discussions when talking about categorizing covered call ETFs. The 3 names now are the anchors, the boosters, and the juicers, as we mentioned in the intro. So the anchors are now going to be what used to be what I called the core base. I'm now referring to them as anchors. They are the stable income and stable NAV ETFs, the covered call ETFs in your portfolio that provide stable income and stable NAV, and even the opportunity for potential of NAV growth. Followed that, I would call the boosters, which initially I referred to as the yield basers, but now I'm actually referring to them as the boosters. Their purpose is to do more income focused work. So they won't look as much about the NAV stability and that, but they're going to give you more income on a monthly basis than the anchors do. And then thirdly, the juicers. And of course, they say exactly what they are. They are what I refer to as the yield maximizers. So these are the 3 pillars of my ETF pillars of income investing. And what we're going to do is go through each one of them. I've got some revised criteria, and I'm going to try to sort of paint a picture what each one of them are. Okay, so I have also done this in a way that's going to be much easier than in the first video where I had a page for each one of them and people had to flip back and forth on it all the time. But I thought, you know what? I'm going to summarize it all in one table so people could look at all 3 pillars at the same time. So here, welcome to my ETF pillars criteria table. On the side, we have the different kinds of criteria: the summary, the yield range, the ETF NAV, distributions, underlying makeup, overlay structure, target weights per ETF, and the role in the portfolio. And then we have the 3 pillars. You can see the 3 pillars: the anchors, the boosters, and the juicers. So let's go through each one of them so people could have a better understanding what the criteria is when you yourself are actually saying, hey, there's a new ETF that just came to town. Nobody's ever mentioned it or categorized it anywhere. So I'm giving you the ammunition to say, oh, okay, so based on what this table says, this would actually be deemed an anchor, or this one's considered a juicer. And we'll talk about later why that's valuable after you can actually categorize every ETF that you know. So we'll start with a summary. As we said before, so anchors, the summary for an anchor is lower yields, stable distribution, and strong NAV resiliency with very minimal NAV lag. So almost every covered call, I'm going to say 99% of covered call ETFs will have some form of lag behind the underlying stock that they, or stocks or indexes or whatever they hold. It's very rare that they ever in a long term actually beat it. And it's very rare that they actually keep it up 100%. They will lag a little bit, but the reason is because when you're giving up capitalizing income, you're going to have to give up something for that. So there will be a minimal NAV lag here. Nothing wrong with that. That's the whole purpose of income ETF portfolio, income ETFs, is that they give up they give up a little bit of NAV appreciation in order to give you an ongoing sustainable income. So for anchors, it's very minimal. Like if you did your own tracking on a chart between that and the underlying, you'll notice that the underlying ETF and the ETF, or the underlying stock and the ETF tend to actually track very close to each other. For boosters, you're going to see a moderate to high yields. You're going to see fluctuating distributions, whereas on the anchors, you saw almost no fluctuation on distributions. They're very stable. But with boosters, you'll see fluctuation of the distributions, and you'll also see fluctuations of the NAV, and you might see increased NAV for sure. And also in some cases, if you've got a bad actor amongst the boosters, you might see some evidence of erosion in some of these ETFs that I'll call them the bad apples inside the pillar. But there is a possibility because they are more aggressive. Now, when we talk about juicers, we're talking about high to ultra high yields, very volatile, lagging distribution often, very volatile distribution, and often sometimes lagging distribution. And that is also some NAV erosion it happens a lot more commonly inside juicers. It's not as shocking to see a juicer have NAV erosion. But if not NAV erosion, in many cases, they have quite significant NAV lag. And if they do have NAV erosion, you're going to also see declining distributions on them. But the yields on them and the distributions on them are far greater than that of the anchors. So I'm just giving you, and again, I want to mention this when we talk about this criteria. This is Perry from the PIIverse giving you my criteria on what I see as anchors, boosters, and juicers. So we'll talk about later about why I'm saying that. So for yield range, I'm categorizing anchors of anything under 25%. In many cases, they're under 25%. In many cases, they're under 20%. In the original video, I actually said it was 30%, but I really actually was hesitant on saying 30% might have been too high. And some people called me out on it, and I do agree. I think I could have almost went down to 20%, but I think I turned around and said, you know what, I'm going to compromise. So anchors could be any cover call ETF that basically maintains a yield under 25%. I would say most of them you're going to see that are going to be under 20%. All right. For boosters, I gave it a category of anything between 25 to 60%. It is a wide range, but when you know what the difference is between an anchor and a booster, the booster's job is to really more accentuate income. And so many of them will use more exotic ways of doing it. Therefore, you can see yields on a booster from as low as 25%. And I'll give you an example. For example, HHIS is now classified as a booster to me, whereas in the first video I had HHIS identified as an anchor. But now that it's over 25%, it is a booster. And then you've got other ones that are like YSPY and some of the others that are at the 50% range. So the boosters do have a wide range of yield. Nothing wrong with it, but that's what is a booster. All right. Juicers, again, and I know people are going to laugh, say a juicer at 25%. Yes. So I have juicers classified from as low as 25% all the way up to past 100% yield. So that is the juicers range is much wider. When we go through the other criteria, you're going to understand why I've even got juicers down at 25%. When it comes to ETF NAV, with anchors, you got very stable a NAV that's stable to its underlying. And I'm going to say stable to its underlying. It doesn't mean that it's rock solid stable and it just never moves like $17 a unit. It's stable to its underlying. So if the global markets go down, and let's say it's an S&P index type covered call ETF, it will go down, but it will be stable to its underlying going down. So if the underlying goes down 5%, it is still stable, but it'll actually decline with its underlying. But that is still considered stable because it's staying in alignment with its underlying. And you will see opportunities for it to grow if the underlying grows. So with an anchor ETF, you're going to see the opportunity and the potential for NAV appreciation because it's structured to allow it to grow when the underlying grows. With boosters, more volatile NAV and levels of NAV lag would be expected with boosters. There may even, if it's a bad actor, I'll call it a bad actor within the category, within the pillar, there may be times when erosion is even possible for some of the covered call ETFs in this pillar. So I'm not going to say that it doesn't happen in boosters. It could happen. Again, the booster gives a range of what would be in this category or in this pillar, but basically, if you fall into it, but you're a bad acting or not a great covered call ETF that has something wrong with its let's say its underlying or with its strategy, it could still have NAV erosion. There's a higher chance of it happening amongst the boosters because they are taking more aggressive methods of doing income generation. And then in amongst the juicers, extreme volatility on NAV with significant lag. And in some cases, quite often, you will actually see NAV erosion amongst the juicers because their yield targets are so high that it's not uncommon for some of the juicers to actually have NAV erosion. But significant NAV lag is a very common thing amongst juicers. If you look at their charts, you'll see it. Okay. There are bad and good actors, and we'll talk about that. So when it comes to distributions, anchors will be very stable from month to month. And the changes when anchors do change their distributions are very small and very infrequent. So I won't say a name of a covered call ETF, but for example, one in here that's very common would be like 17, 17, 17.1, 17.1, 17. It changes very infrequently, and their distributions month to month also changes very little when it does change. That's a very common attribute for anchors. Boosters have fluctuating frequently and moderate changes. It's rarely stable amongst the boosters. So if you ever see when you do your covered call ETFs and you see the ones that are in there and go and look at their distribution list, I'm not saying this always happens, but generally speaking, a covered call ETF in the booster category will generally have a month-to-month fluctuating distribution. It's very rare that you're going to see what you see in the anchors. You won't see 17, 17, 17 that often in a booster. I'm not saying it doesn't happen, but it's very rare amongst boosters to see a monthly distribution that is very stable and does not change. And the other thing is when they do change from month to month, it's actually quite moderate changes. So it's not going to be like in the anchors where you'll see 17, 17.1 cents. They'll likely go to like 17, 25, 13. So the magnitude of each change is much bigger in a booster versus an anchor. For juicers, it's always fluctuating. It's dramatically fluctuating. Every declaration, it's basically rolling the dice to find out what you're going to get. It's very often declining as well. If the covered call ETF is one that is doing NAV erosion, you'll not only see dramatic changes, you'll also see that over time it might be showing a decline of its distributions. So it is the risk you take when you want a covered call ETF amongst this category that is generating ultra high yields. The point is that you're really riding a bronco when you're riding a juicer. Okay. Underlying makeup. For anchors, it's basically the underlying makeup is going to be indexes, composites, and all-in-ones. A single ETF of the above is allowed. And what I mean by that is you can turn around and be a single holding, but if the single holding is something like the S&P or the NASDAQ index, that is still deemed an index. You don't have to hold all the shares and all the stocks that make up an index. If the Covered Call ETF holds an ETF that actually holds the entire S&P or the index or an entire sector, that is still considered a sector underlying, even though it's only one asset, which is an ETF, because basically they're using another ETF to put all those underlyings into their basket as opposed to them having to buy all of them at one time. All right, so that still counts. With boosters, everything's the same. So one thing I'm going to notice here, and you're going to see, we're going to talk about it in the next page, anchors and boosters, when it comes to the underlying makeup, are the big differentiator between them and juicers. They, like anchors, use indexes, composites, and all-in-ones. They also are allowed to use an ETF that actually includes indexes, composites, or all-in-ones. All right, so those two are the same. What differentiates biggest by far a juicer versus the other two is that they are exclusively a single stock or a single investment covered call ETF. A single ETF of a composite is exempt. It's not allowed. So you can't turn around and say that, oh yeah, but a juicer basically has an ETF of the S&P. Then it would not be a juicer. It would now be moved down to being a booster, because a juicer must be a single, at the atomic level, they must be holding a single stock or a single investment, one element. And that's the number one element that basically separates a juicer from a booster. Because a lot of times when you're doing your own categorization, you're going to turn around and say, oh yeah, but this guy's, his yield is really low, but he's a single stock. I'll give you a good example. If you use something like LLHE from Harvest or something like that, which has like a 21% yield, very low, but it's a single stock. So even though it's got a very low yield, and you'd say, well, that's almost an anchor, it's so low, it instantly becomes a juicer because its volatility is tied to it being trusting on one underlying. And therefore, it doesn't matter how low the yield or how high the yield. If the Covered Call ETF holds a single element stock or bond or something specific, it is now instantly referred to as a juicer. The overlay structure, again, for those that don't know much about covered calls, you're going to have to do more research here. But these are some of the elements in the criteria that would differentiate an anchor to a booster to a juicer. So an overlay structure, or an underlying structure, or I'll call it an overlay structure, it's basically the mechanics around the underlying. What are they doing to the underlying that's making it do its magic? In the case of covered call ETFs and income-based ETFs, they're doing these overlay structures to generate income. And of course, the covered call contracts are the overlay structure. So the mechanics of some of these for anchors, it would have coverage of the underlying of under 50%. Many of them are actually, I didn't want to say 30% because there might be a few that actually go up to 40, 50%. But even for those that actually, those covered call ETF companies that actually have them, they'll say that they can write contracts up to 50% of the underlying. Most of the time they don't. They actually write it at a 40 or even 30% or even lower. So that is absolutely a big criteria for anchor covered call ETFs. They have very low coverage of their underlying. The reason that's important is because that is a key element of what allows them to track a lot closer to the underlying for growth. So when a covered call ETF as an anchor, it can grow because of that one element, is that they don't write contracts on the entire underlying. They only write it on a portion of it. They're also often, and I won't say every time, these are just broad categories. They often are less aggressive on their moneyness. Moneyness means how close are the covered call contracts being written, the strike price being written. when they write the contracts. So they might be further out of the money in many cases. That doesn't mean that they will be. They do have the flexibility in their prospectus to come closer or farther away from the money or from the price. So they could write strike prices that are really close or very far, but generally speaking, they're generally less aggressive on the moneyness, and that's the moneyness. The other thing that you're going to find surprising here is that there is none to moderate leverage on anchors. So a lot of people would turn around and say, well, Perry, why would it, if a covered call ETF is using leverage, that makes them higher risk. No, it doesn't make them higher risk. It makes them more volatile. If you're an income investor and if you are buying and holding something for 2, 3, 4, 5 years, the fact that leverage makes your covered call ETF's price fly up and down a little bit more than normal because it's using leverage is not a risk. It's just a more volatile. It adds volatility to it, but it also adds a little bit to the yield. But I personally don't consider moderate leverage. And when I say moderate leverage, usually it's about 25%. There's a few that have now gone up to 30%, but under the anchors, they're not. In the anchor category, if there is leverage on a covered call ETF, it's usually at 25%. So I'm saying that an anchor can have moderate leverage. Again, if you're writing your own criteria table and you feel that that's not correct, you can write your own criteria table and take it off the table. For boosters, you're going to see basically a higher coverage of the underlying because they're trying to generate more income. And the only way you could generate more income is to have contracts on a larger portion of the underlying. So in many cases, you'll see the booster-based covered call ETFs at 50 to 100% coverage of the underlying. You're going to see potentially them writing more aggressive moneyness, like very close out of the money or maybe right on the money or at the money type of calls. They're going to do things that are more aggressive so that they could generate more yield out of their underlyings. You're also going to see things like exotic overlays. You're going to see them using things like swap agreements and potentially synthetics. So those are things that'll start showing up on boosters. And also, they will use, again, between none and extreme leverage. So, I'm just wanted to clarify that similar to anchors, boosters will use leverage at times, sometimes not. But when they do, they don't only stop at moderate. Some booster covered call ETFs will actually do extreme leverage, like 2 times, and even in some cases, 3 times leverage. So, that's what makes them different from an anchor. On juicers, same thing, 50 to 100% coverage on the underlying, very aggressive moneyness. They also use exotic overlays like swap agreements and synthetics. And again, none to extreme leverage. They're very much like the boosters. They may be using a lot more aggressive, a lot more volatile with higher IV stocks, but they're doing it on single stocks, which that's the only difference. Boosters and juicers are very similar, but juicers are using single stock underlyings, and that's what makes them generate potentially a lot more income, is because a single stock will be a lot more volatile than an index, and that's what differentiates a booster from a juicer on the overlay structure. Other than that, they pretty much use the same kind of structure. So what I've got here on the next one is target weight per ETF. This is Perry's personal opinion. You guys can do whatever you want. Matter of fact, I don't even believe with some of these. I'm just going to say this. So what I'm saying here is if you have an anchor ETF and you want to put it in your portfolio, thumb in the air, you could turn around and say for an anchor, you could make an anchor covered call ETF or an anchor ETF as much as 10% of your portfolio. The reason is because it's a lot less risky, a lot less volatile. It is basically a foundational type of ETF. You can take, let's say, more risk with it because there is less risk in an anchor ETF. So if your portfolio says I allow up to 10% target weight on any ETF, then you could, for this one, do something like 10% of your portfolio. Let's say it's like HYLD. You could say, you know what, I do allow 10 or 20 or 15%, whatever it is, I allow it, but I'm saying that you should maybe max out at 10%. That's my personal opinion. My portfolio doesn't allow 10%, so that's why I've got things in brackets. I'm saying maximum 10% or your portfolio's max target. For my PIIverse portfolio, I generally have a rule that says no covered call ETF should exceed 5%. I do have a couple that bend and break those rules, but it's only a couple. So I would not, even though this says that an anchor can have 10%, my portfolio says I don't allow anything over 5%. So I would allow 5%. For an anchor, and maybe a little bit more. There is a couple like ENCL, which I believe I'm at 8% on. So I would be allowed for an anchor to do that. I would never allow any of the others to do that. For boosters, I'm setting the number that if 10% is good for an anchor, a booster should be no more than 5% of your portfolio. And I'm only saying no more than 5%. In many cases, you have to do your own thinking, your own soul searching with regards to how much each covered call ETF should have as a target weight. For example, if it's a brand new booster covered call ETF and it hasn't really tested the market yet, you wouldn't right away go out at 5%. You might say, you know what? Yeah, if this guy really proves to be a good ETF, I'll move it up to 5% someday. But you might initially say that, no, I'm only going to start it at 1% until I can actually see some performance on it. What I'm saying is the maximum for a booster should be 5% and no more. Again, if you have portfolio rules that says boosters should not exceed 5%, they should only be about 3%, then you would basically max out at 3%. But I personally think you should never go beyond 5% on a booster. And then finally, for juicers, they are extremely volatile, very, riding bronco type of ETFs. And for that reason, I would say that no juicer should be more than 3% of your portfolio. And again, it could even be less if your portfolio says, no, I'm very conservative about juicers. I won't even allow more than 2%, excuse me. But again, I can't see, in general speaking, that you should really have a juicer make up more than 3% of your portfolio. They're just too wild, too volatile, and you want to sort of contain them. They do some great work for you because they generate ultra high yields, but you want to make sure that if anything goes bad with them, anything goes south, they erode too much, you're not going to be losing much of your portfolio because it's only up, each ETF is only 3%. Each juicer ETF is only 3% of your portfolio. All right. And then finally, this is sort of a general role in your portfolio. If I actually had to provide some general compass on what each pillar holds. So let's go through it. For an anchor, I would refer to these as the foundational ETFs. These are the reliable, stable, low risk income ETFs. They're very, very little reinvestment is needed on them because they actually track so close. They have very little NAV lag. They don't need as much reinvesting. They are ideal for long-term and risk dampening in your portfolio. They, of course, generate far less yields than your juicers or your boosters. But if you're looking for something that's going to provide stability, a foundation, a base to your portfolio, these are critical. I honestly, I think everyone, no matter where you are in your income portfolio investment spectrum, they should have some anchors ETFs in there for sure. I think they're just critical. They're foundational for a reason. For boosters, I would call them the income enhancing ETFs. They have higher income with manageable volatility, meaning they are more volatile, but you could do things quite easily to maintain that volatility. You'll have some moderate reinvestment needs. And when I'm talking about reinvestment needs, I said it before on the first one here, the moderate reinvestment needs means you need to put some of your monthly distributions back into reinvesting. For an anchor, the minimum you're going to be put it in there so that your portfolio is growing against inflation. Anything beyond that is you're going to do what's called compounding income. The more you reinvest, the more your monthly income will slowly start going up. If you weren't looking at making your income go up and all you wanted to do is provide addressing inflation and maintaining NAV, for an anchor, it'd be very little need to reinvest. For a booster, you're going to actually need a more moderate level of reinvesting is needed. But they are still considered long-term, but you might need some tactical rotation possible with a booster. So maybe after 2 or 3 years, you're sort of saying, okay, you know what? This one ETF, booster ETF I think I can find better options elsewhere, or, it's running long in the tooth. You might decide that you want to do what I refer to as rebalancing tactical rotation on them. There's a higher chance of them in boosters. In anchors, I don't think you'd ever really want to do it unless you're trying to capitalize some gains that trim off some gains. But generally, foundationals is things you'd hold forever and ever because they're basically the foundations. And then for juicers, I added the word boutique. And the reason I'm doing it is I consider juicers to be the added value you'd put on your portfolio in addition to having a good foundation and having a good set of income producing boosters. You would add juicers as that little boutique add-on to say, you know what? I'm going to add about 10% into my portfolio to tap into that 80% yield. I know that the risk is limited because I'm only putting that much in. So I refer to it as the boutique high octane yield ETFs. They maximize yield with extreme volatility. Get ready to ride a bronco, as I said. They will have significant reinvestment needs, and you should, in many cases, consider them to be shorter term plays. I don't anticipate many juicers will last 20 years. They might, but they literally would trickle down and generate less and less monthly income if they are the ones that are eroding. So you can have them and you could hold them for several years, but generally speaking, you might consider them to be potentially shorter term plays. All right. So that is the criteria that we're talking about. And again, I'm hoping people like this thing, and I'm sure they've got a lot of their own ideas saying, Perry, I would rather do it differently. Totally, I agree with you. Whatever each investor needs. All right, so now we're going to talk about some important notes about the ETF Pillars table that wasn't captured in the review of the table. First of all, the ETF Pillars table provides a general perspective of the types of income ETFs on the market, and it provides guidance for investors when categorizing an ETF into one of the pillars. Again, the key word there is general perspective, okay, or prospectus. Many ETFs won't fit 100% into any one pillar. You're going to run into this quite often saying, well, it's a lot of this one, but it's a lot of that one. My answer to that is they will fit best into one of the pillars. So whichever pillar that Covered Call ETF fits best into, that's the one you would actually add it into. Again, it may not be 100%, but you can see from the nuance of saying, okay, yeah, it doesn't fit into it 100%, but based on the criteria, I can easily categorize this thing as a juicer. All right. So you come up with your own understanding saying nothing's perfect. There's no law that's going to say that this one must be this or this one must be that. Do it based on what you believe is best fit. And that's what I'm saying here. Categorizing ETFs into pillars is not a universal rule. This not like E equals MC squared. Each investor is ultimately the authority on this. So if I turn around and say that LLHE or LLHY is actually not a juicer because it's so low on its yield that it should actually be at least be considered a booster, that's your choice. Everyone can make their own choice. Again, this is basically a resource tool for you to help you build and maintain your portfolio. So this is only a guidance thing. Feel free to do it whichever way you want. For every pillar, there will be rock stars and there will be bad apples within the pillar. Okay? The best way I can give an analogy, it's like a basket of apples. Some might be rotten, some might be big and juicy. But at the end of the day, everyone in there is still an apple. The basket is still loaded with apples. And what I mean by that is you might see some real rock stars. For example, I'll give you an example, PLTE, Harvest PLTE. It is actually considered a juicer, but It's a single stock juicer, so it's a good one. But then you look at something like LLHY or, Eli Lilly or whatever. I'm using Harvest just arbitrarily. And you'll say, wow, why is he in there in the juicer? That's the thing. The other thing is you're going to find, for example, I'll give you another example. Alti fits in the boosters because it is actually based on a composite. It's not a single stock. But a lot of people say the way it's been eroding and how crazy it is on volatility and stuff, it belongs to be a juicer. But at the end of the day, it still meets the category of booster. So it's a bad apple within the booster. Maybe someday it'll be a good apple, but you see what I mean? Even though all the apples are in there, some are bad apples, some are good apples, but at the end of the day, it's still an apple. It's still a booster if it's good or bad. It just happens to be a bad actor in the category. The other thing I already brought up once before, the primary differentiator between juicers and the anchors and the boosters is single stock underlying versus some form of composite underlying. This differentiator should be used to place even low yielding single stock ETFs. And I used the Eli Lilly ETF. It has a very low yield. It is a single stock. I still consider it to be a juicer, even though it's a low yielder, because at the end of the day, just because it's a single stock, it makes it a juicer because it is more volatile because it's only a single stock. Finally, the ETF pillar table presented here is only the my PIIverse criteria. Each investor can make their own table up. You can add, change, remove any criteria to make the pillar table work for them or you. So I'm just showing you what I would do for my portfolio and my criteria. Feel free to create your own table of what these three pillars are and come up with your own yields, your own categories, your own criteria. I'm giving you basically sort of inspiration to say, how would I do it for myself? If you want to use exactly the same criteria as me, that's great. If you don't, please go ahead and change it because everyone's income investing journey is personal to them. I'm not dictating how you need to use this criteria table. All right. Now, how do investors use the ETF Pillars table to create their own diversification strategy? Because now I've shown you what ETF Pillar table looks like and what the ETF Pillars are. But what's going to be really critically valuable here is how you actually can use the pillars to help you develop a strategy and maintain a strategy regarding diversification. So let's talk about ETF Pillars for diversification strategy. A critical component of any investment portfolio, regardless if it's growth or income, is diversification. I can't say it. It's like in real estate when they say there's three things, critical things for real estate, and that's location, location, location. For investing and developing a portfolio, investing portfolio, the three things for a portfolio strategy is diversification, diversification, and diversification. For a passive income portfolio looking for both sustainability and to try to reach a target monthly income, a well thought out diversification strategy is even more critical. So the toughest questions when you're developing a strategy, most newer income investors are saying it. I hear it all the time privately and on the channel. What ETFs do I hold? What should I hold for diversification? Which ETFs will align with my risk tolerances and my target income? How should I blend low and high risk ETFs together? What guidance do I use when I'm selecting ETFs? They're all generally saying, yeah, Perry, you're saying I need diversification, but this is such a Mount Everest question you're asking me to answer. I need some guidance. Well, the good part is this is going to help you guide better on answering these questions. So using the ETF pillar table, you can now get a much more clear picture to help you answer those questions. So what I'm suggesting here is a thing called assigning ETF pillar weights for your portfolio to maintain your diversification strategy. So what we're going to basically do is investors would look at their goals, understand their goals, say, okay, I'm a conservative income investor, or I'm an aggressive income yielder, whatever your goals are. you're going to then turn around and say, okay, I'm going to assign ETF pillar weights for each of the pillars that would best align me towards meeting those goals. And we're going to talk about examples of what that means. But by actually doing your target weights at a pillar level, as opposed to an ETF level, that's going to help you. So once you've got pillar weights assigned, so for example, let's say you set your anchors at 60% of your portfolio, you now can then use the ETF max level target weights recommended in each of your pillars. Investors have a much more guidance on what, how much, and how many ETFs in each pillar to hold and maintain. So again, if you're turning around and saying that you personally say that sorry, I got a brain stall there. If you're saying that your anchor ETFs can have a maximum per ETF of 5%, and you know that you have 60% of your portfolio should be basically anchors, you can then do the math and say, well, how many ETFs is that based on 60% of my portfolio and having a 20%? So, 5 times, it's 12. So you should have like 12 in there. I'm just using my math in my own head. But you can see how you can reverse engineer and saying, since I know my pillar weight for anchors is 60%, then I know how much I'm allowed in my portfolio to put per each ETF for an anchor. You can do your own math, say, okay, well, that means I need about 11 or 12 ETFs in this category. All right, you see what I mean? You can also then determine and say, okay, if 60% is also based on how much your NAV is, you can also do that same NAV, that same calculation. So you could see, by actually setting weights at the pillar level, it right away trickles down really quickly to a level of making you better understand how many ETFs of each pillar do you need. And now you can start picking which ETFs need to belong in your diversification strategy. So let's see some absolute examples. Like, these are not real examples. These are right pulled out of my head of maintaining diversification by assigning ETF pillar weights. I think this is going to really help you see the visualization of what I mean. All right, so these are examples of ETF pillar weights. I'm going to say before I show you the first one, these are absolutely arbitrary. I don't think I have to say this, but I'm going to say it again. These are not real. I'm not recommending anything. I've just sort of arbitrarily picked a strategy and a goal, and I said, okay, here's potentially how you could do it. None of these are actual true. I've done no research to see if these really work. I'm just giving you examples. So let's go with the first one. So let's use something where we're saying we have a conservative investor. If he looks at his goal, he says, Perry, I'm a conservative investor. I want income and growth. I want to see a little bit of both. I want to see the potential for growth, but I also want to see some moderate income. I'd like to see a yield in the 10 to 15% range. And I'd like to see some NAV growth potential. So I'm going to give you 3 ways of doing it, because what I want to show you in this example is there's not just one way to skin a cat. Coming up with the same goal, I could do it so many different ways. And this is why it's really up to each investor how they want to do it. For example, and again, these numbers are arbitrary, but I'm just sort of thumb in the air. I could turn around and take one strategy, diversification strategy, and say, I'm going to invest everything on covered call ETFs that follow the anchor pillar. I'm not going to have anything in there but anchor pillars. Because anchor pillar ETFs are allowed 10%, that means 10 out of 100. That means 10 ETFs. You could put 10 a minimum of 10 ETFs into this portfolio. It'll be income anchor ETFs, so there won't be anything else other than ETFs that generate 25% or less, generally 20% or less. A lot of these covered call ETFs in the anchor category are 14, 12, and 10%. So you're going to likely see maybe even somewhere in the 8%. Again, the category is very broad spectrum. You might turn around and say, I'm going to pick a few like JEPI that is only at 6% and some of them at 8%, but I'm also going to add a few at 15%. I generally think if you follow it here, you're going to see a very minimal reinvesting, because you're basically taking growth slash income ETFs to build your portfolio. So you're going to see a very minimal reinvesting, 5% just to cover off inflation. You're going to see very minimal compounding income. And this is an important thing. It's a limitation if you're going to take a conservative approach. The less you reinvest, because you're not generating as much monthly income, so you can live closer to the edge with regards to it, because you know you don't have much volatility, but you're not going to be able to put any much excess income back into your portfolio, not unless your portfolio is so large that 10% of a very large portfolio still gives you tens of thousands of dollars. But generally speaking, you're going to have minimal compounding income because you're going to be living closer to the edge. Again, every investor is different. So if you've got like a $10 million portfolio, then a 10% yield is nothing to sneeze at. That's still a lot of money. So, all right. But you could also skin the cat another way. You could turn around and say, okay, in order to get the 10 or 15% yield as a conservative income growth investor, I can do 80% anchors and I can do 20% boosters. Because boosters actually have a restriction on how much they should be on target weight, you might need now 15 or more ETFs as opposed to 10, because you're restricted on how much of a target weight each of the booster ETFs holds. You might then turn around and say, if I'm going to do an 80-20 rule, you're going to maybe turn around and say, okay, I'm going to then use a much lower growing, like you're going to pick anchor ETFs that do a lot more growing and less more income, like a JEPI or something. And you're going to then turn around and use the boosters to generate higher yields. So you might have some 30%ers and 35%ers working with some very conservative 8%ers. Again, this is why I'm trying to show you in these examples why it's really up to you. You are the architect of your own portfolio. You could turn around and do anything, because these ranges are so large that there is no saying if I pick an anchor, it's going to be 15%. It could be as low as 5%. It could be 8%. But in that range, you could say, I'm going to mix some of these and I'm going to mix some of this. Basically, I give you the Lego blocks. You build your own Lego house with it based on meeting your goals of what the house is supposed to look like. And then another example, again, arbitrary, but another example, I could say 60% anchors and 40% boosters. So that means I might need as many as 20 ETFs because I'm holding more boosters with a lower target weight per ETF. I'm going to do some growth ones, but I'm also going to use a lot of income ETFs from the booster side to get me to a weight. I might get closer to about a 15% yield. I'm just using an arbitrary number, but you might get closer to 15 because you're tapping into more of the income generating boosters that anchors don't have. All right. As you can see, the more aggressive you get with regards to using boosters and juicers, you're going to see a need for more reinvesting. So whereas the other one was at 5%, now you've tapped it up a little and you might have to do a minimum of 8% reinvesting. You're also still going to get a minor compounding income, more than the last one, which was like very minimal. But in this one, you might be able to increase your compounding income. So when I say compounding income, what I'm saying here is the fact that every time you reinvest, you're not only protecting and stabilizing your NAV, but every time you reinvest, you're compounding your income, because whatever gets reinvested goes to another covered call ETF that generates more income, which then generates more income. And that's why it's compounding. The more free excess money you have, because your yields are basically higher and you're using less of it for expenses, means you could put more back into the portfolio. And that's why minor compounding happens as opposed to minimal. Okay, let's use another example. Let's use a guy like, I'm a moderate income investor. I'm looking, Perry, for something in the 20 to 30% yield. That's about the number I need. I still would like to see some stable NAV, but yield is becoming a little bit more of an important factor. So I'm not going to go through these as articulate as I did in the first one. But for example, you could do an example in this set of goals where it's like, I'm going to do 75% anchors and 25% boosters. And again, you might need over 15 ETFs. You might hold higher yielding boosters because remember, HHIS is a very low level booster, but something like YSPY is like a 52% booster or 48% booster yielder. So even amongst the boosters, you could have somebody that just barely squeaks in as a booster like HHIS at 25% 27%, but you could also have a YSPY one that's running near 50%. So the kind of boosting ETF you might put in here could change, even though it's still just called a booster. You would likely see in this kind of layout of 75 anchor, 25 booster, a yield closer to 20%. You'll see that your minimum reinvesting is the inflation plus a little bit more to maintain a little bit more stability, because you're tapping into more boosters that have a little bit more NAV stabilization reinvestment needs. You're still going to see a minor compounding income because you're going to have higher yields, meaning higher distributions, meaning potentially more reinvestable money to put back in above your expenses. Then you could also take another approach saying 50-50, 50 anchor, 50 booster. And you can say, okay, well, now I need, because it's 50 booster, I need 20 ETFs. I'm going to focus only on more income, not as much growth. I'm going to be closer to the 25% yield. I'm going to do a minimum of about 10% or more reinvesting. You can always do more. And I always recommend putting whatever you don't need for expenses. If you were retired or fired, I would reinvest everything you don't need back into the portfolio. All right. Because that means more compounding income. And in here, you can see it switches to more of a moderate compounding income. And then I'm giving you another example. In this one, you could say, I'm going to start introducing the juicers. So I'm going to do 50% anchors, 40% boosters, and 10% juicers. So now I need over 25% covered call ETFs. Income enhancing ETFs are now going to be there. You're going to get a lot of more income coming out of your juicers that were not available in your anchors and very little in your boosters. You're going to need to put at least 10% reinvesting in here because you're still under 30%. And you're going to see a moderate compounding income. Again, just arbitrary examples of how you would structure your diversification, but these are just examples that I could come up with. And then in the basket, the third one I'm going to use is, and this is where I fall into this category, the high yield income investor. It's somebody that's in the 30 to 40% yield. They're looking for that. They would like to see some stable NAV, but they want to see yields of 30, 40%. So in a case like mine, I could do something like 75% boosters and 25% anchors. I could do something like 34% anchors, 33% boosters, and 33% juicers. In other words, basically evenly divided three ways. Or I could do something like 30% anchors, 30% boosters, and more juicers. So I'm actually increasing my juicer because I'm willing to take more chances. I should have said here, this was wrong. I'm going to have to correct my diagram here. It should have said closer to 40%. Please, if you see this here, I say closer to 40%. It should say 40%, not 30%. I will correct this PowerPoint document here. Please notice that. It should have said closer to 40%. You're going to see minimal reinvestment at a much higher level. When you're in the 30 to 40% range, you're going to see minimum reinvesting of about 50 to 55% potentially, because you're getting closer to that 40% range. So it all depends. Again, one thing people say, well, how much should I reinvest? Remember, reinvesting to maintain stable NAV, it all depends what the markets are doing. If we're at all-time highs and we're going up every month, then reinvesting to maintain a stable NAV is not going to be something at 55% because nothing is eroding on these juicers. They're actually going up in many cases. So keep that in mind. Reinvesting to maintain stable NAV is a dynamic thing. The investor has to decide on a monthly basis or every quarterly basis if they need to add more to it or less. But again, there's no rule that says at 40%, you must do 55% reinvesting. It's all dependent on dynamically watching your NAV and seeing if it needs more or less. You will now also see much heavier compounding income. Because my portfolio, for example, runs in the 35 to 40% range, I can reinvest 60, 65% of my portfolio back into my portfolio. It means I'm actually doing heavy compounding income. And that's why in my case, my portfolio has grown on monthly distribution, is because I'm putting so much back. All right. So I hope these are examples. You can then turn around and say, I'm going to do my own and I'll come up with my own formula. It's everybody's portfolio is unique to them on which max. But what I'm trying to explain to you is if you can, the key part would be for you to turn around and say, I'm going to maybe set some initial targets for my pillars of anchors, boosters, and juicers. And you can see that you don't have to have every one of them. You might go all 100% anchors, or you do a very big blending of boosters and juicers. And I didn't even take into account in here the fact that you could also be a hybrid investor. And this is just one side of your portfolio. You could have another 15% of your entire portfolio that's all growth and dividend. So keep that in mind. This is just the income side of it. If you're hybrid, you have added target weights on the side that this side's not even talking about, and that is how much you're investing in pure growth stocks and dividend growth stocks. So keep that in mind. All right. Now, I told you that the bottom one is very closer to mine. I'm going to now show you what mine actually looks like. I actually took the old video. I went and got an updated version of my diversification layout from Snowball Analytics. If anybody, I am an affiliate of Snowball Analytics. If anybody's interested in Snowball Analytics, if you use my link in my pinned comments, I get some reward for it. But anyways, I just wanted to call it out that I am an affiliate of it. I do use Snowball Analytics for the last 2.5, 3 years. I use them all the time. This chart that I'm going to show you came from Snowball Analytics, and I'm going to use it to show you, now that I've updated the criteria on my ETF pillars, I'm going to show you what it looks like right now. What I'm also going to tell you is and I'm going to pull this up right now, I've done some major updates to my main portfolio spreadsheet. I am now got a new column in my portfolio spreadsheet that tracks all my ETFs based on if they are anchors, boosters, and juicers. And this little clip you see here is basically coming right from it. This is actually now articulating my breakdown of my anchors, boosters, and juicers, both by the number of ETFs that each holds and also by their NAV, their NAV percentages. And this is going to be something pretty cool. So I'm not going to go through every one of them, but I did see some changes here. So if you watch the previous video, because I changed what an anchor was before, or I called it a core base at the time, from a 30% down to a 25%, I lost Biggie and I lost HHIS for sure. They are now deemed boosters. So I basically increased my booster count and reduced my anchor count. So I had to restructure this. I made some changes in sales and buys and stuff. But anyways, I'm not going to go through each one of these. You could freeze the screen and look at all of them. I'm just going to focus on it. This is as of December 16th, 2025. That's today when I did this video. You now see that my pillar target weight, now it's not my target weight, these are my actual weights. So my actual weight on NAV is that my anchors make up approximately 40% of my portfolio. My boosters make up 30% of my portfolio, and my juicers make up 30%. So it's 40, 30, 30 is generally the way it works out. Very surprisingly, that's very close to what I mentioned over in the previous one, which said, here's some examples. Let me just go back to them again. Yeah, is this one here? So you see, here's the one here. This one was 34, 34, 34, 33, 33. So it's maybe closer to one of these, but you can see that I'm very close to what one of these two arbitrary ones are here. And again, I didn't do that to make the match. After the fact, I looked at it and say, oh, well, look at that. I'm very close to this. So anyways, this is what the layout is. Anyone wants to know, but if you are doing your own portfolio and you have already built a portfolio diversification, say you have about 15 or 20 already inside your portfolio, you might now use this ETF pillar table and say, okay, John, let me see what this is. Okay, let me see wow, I'm conservative, but for some reason I've got a lot of juicers. And does that really make sense for me if I'm a conservative investor? Maybe I should be reconsidering and doing some adjustments and do some long-term rebalancing planning to say, maybe I need to get out of my boosters and move more to my anchors, because I thought I was actually a conservative investor, but I'm actually looking like I'm more of an income producing investor. So this is going to hopefully help you, give you a better perspective of your own portfolio. And that's about it. All right. So I'm not going to talk any more about it. You guys could freeze the screen. You could see how all my ETFs are all categorized in here. They've been all up to date on, if they're green, they are considered anchors. If they're yellow, they're considered boosters. And if they have a red tag beside them, they're considered juicers, and they're based on my criteria and my interpretation of my own criteria. All right. So let's talk about conclusions. I hope this was valuable for you. I discussed the newly labeled ETF pillars of income investing: anchors, boosters, and juicers. I presented a new, simple, consolidated ETF pillars table with changes and refinements of the criteria based on your feedback from the first video, and I've incorporated it into the new revised table. I showed you how these ETF pillars can be valuable resources to help income investors more effectively structure and maintain their own portfolio diversification strategy. I provided several examples of how the ETF pillars can be incorporated into hypothetical portfolio goals by setting alternative different ETF pillar weights and saying, okay, I'm going to do target weights here, target weights there. And you can see how there were several different ways to come up with the same answer, even on a similar goals. You could see how every investor could be handling it in a different way. So I wanted to articulate that. So you say there is no one answer to say, Perry, I want to reach 15% yield. What ETFs should I buy? I'm putting the ball back in your court. You decide which ETFs you should buy based on how you want to tackle your ETF weights for your pillars, because there is no one answer, and the only one that can answer that is not me. First of all, I'm not an expert. I'm not a certified planner. It's your job. All I can do is give you tools to help you maybe figure it out for yourself. And then I finished it off by showing you how the ETF pillars are structured in my own PIIverse portfolio. So you could actually see a real life example of the ETF pillars and their target weights and their actual weights being used in an actual portfolio. So just to finish this off, preparing all this content for this video was a lot of work. It took me 3 or 4 days to build this up. I hope you all found this valuable. And it would be really appreciated if you guys could press the like button on this video. And even more importantly, if you haven't already joined and you like content like this, because I do focus on passive income investing strategies. I don't tell you which ETFs to buy. I just tell you basically some strategies that I use, and it might be helpful for you. If this is very important for you to help you mature and build up your own portfolio, please join my channel. I would really appreciate it. By the way, as a final conclusion, this is a PowerPoint presentation. I will convert it to a PDF. And for all my growing number of valued pillar members, I call them pillar there too, my PIIverse pillar members, which is a growing number. I think over 80. Thank you very much for all you guys joining me. The pillar members, you'll find this PowerPoint presentation as a PDF in your Google Shared Drive. You could download it for your own personal use. All right. And then until next time, stay safe, stay investing, and I will see you in the PIIverse.